Hi there, everyone. Happy Friday, February 7th. Welcome to the special All-Mailbag edition of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully clear and sunny, but still quite snow-covered Redmond, Washington. Ended up getting about 8 inches of snow on our property this week. Not great. Schools were just open today for the first time this week, so we are limping through the month of February so far. My family, fingers crossed, kind of getting through the flu bug, as I know many are struggling with. So I wish you all good health and good investing success. Talk about not a successful end to the week for now is the S&P 500 here. We're just getting to the U.S. Equity market close as we're recording the episode today for Friday, and did not go particularly well. What we'll do today on our All Mailbag episode is do a quick rundown on what we saw of the markets today. And again, weaker rather than stronger is the story. We'll talk about some of the charts that stand out and then get to 6 fantastic questions, time permitting, that I've pulled from just questions we got in the last couple of days. Again, I can't thank you guys enough for sharing some really thoughtful questions with me over the years and certainly over this week. These come from our live stream when we live stream the market recap show every day. Comes from comments on my YouTube channel, from social media as well. So please keep the great questions coming. Really helps me to think about where I want to focus some content and helps me address some of the things that you're running into, which I very much appreciate. Now, with that in mind, I mean, what's happening here as we wrap the week, and again, I spend more time over the weekend kind of digesting here, but you know, there was a chance after Thursday with that nice rally going into the close. There's sort of this feeling that Friday could be kind of that, you know, all right, at least we finished the week strong, go into the weekend, despite some companies missing earnings. Sure, Alphabet, Amazon are down, but at least we had a strong finish to the week. Now, the S&P did hold above 6,000, it looks like, going into the close, but certainly another distribution day. You'll note that the breadth, as you dig into Friday's data, weaker rather than stronger. All 11 of the actually one of them, energy, ended up being flat, it looks like, just slightly. But most of the sectors were down quite a bit today, varying degrees. That's not fair. Some sectors like consumer discretionary really leading the way lower, but on average, stocks continued to pull back here. Just again, sort of initial thoughts. We talked about that axis of evil in the middle of the market carpet. Friday, another example of that particular pattern. Alphabet, Amazon, Tesla, all of these stocks were down 3 to 4%. Again on Friday, and that's after coming through a pretty painful week. So end of the week, Alphabet shed about 9% of its value this week. Tesla almost 11% of its value. So while other stocks like Nvidia, like Eli Lilly, like a Costco, a T-Mobile had some pretty decent weeks, some big names with some big weights are feeling the pain, and other things like Apple and Microsoft, they're just not going up, right? They're going down. And so I think that while a lot of these are not too far off of all-time highs, while the long-term trends arguably are still quite strong, I think in the short term, we're certainly seeing some distribution. You know, as I reflect on this week, again, initially, I'm just seeing what we saw this week as another failed attempt to push above 6,100. As I mentioned in previous shows and in previous months, you know, a bull environment is when stocks don't just trade to resistance, they trade through resistance. And if you look at what the S&P has done from mid-January to now early February, we have traded to resistance of 6,100 from early December. We have very much not traded through resistance. While the S&P, again, is not too far off of an all-time high, you know, from less than a month ago, we're not going up and we're not breaking out. And if you look at where we ended this week, it's pretty much where we were at the end of the first week of November. So from, you know, the month of November, December, January, 3 months later, we've gone nowhere. All right. It's been a nothing burger trend wise, even though there's been a lot of movement, certainly a lot of question marks. So what that means is you had the initial Trump, election bump. We had about 3 more days of an uptrend. And today, Friday, February 7th, we are at the exact same point that we were at the end of election week. So if you're thinking that this is still a bull market, I don't blame you from the fact that we're not far off of all-time highs. I don't blame you if you look at Costco and Palantir and Meta and think these stocks are going up. They all are. However, from a trend perspective, right, the trend, the rate of change, the 3-month rate of change on the S&P is dead zero. since early November. That to me is the big takeaway as I'm digesting things. And what that means is just we have a market that's stalled out. Candle pattern on the S&P, it's not a classic one. It's not a clear bearish momentum divergence, but look at the last couple of weeks here. We've had kind of a rally, then a big black candle as we make a new high, swing high, big black candle on Friday, big swing high, big black candle on Friday. Friday's kind of been the killer here over the last couple of weeks. And just today's candle is very similar to the end of last week, where it looked like, we kind of stalled out after a decent opportunity to, finish the week strong and have 5 straight up closes. Not the case. And I think the real story are charts like Amazon, charts like Alphabet, right? Alphabet in less than a week has gone from making a new all-time high, closing above 205 for the first time on an adjusted basis, to gapping down to the 50-day moving average and then failing to hold it. And going into Friday's sessions, we talked about earlier in the week, we have this big bearish divergence on the chart of Alphabet, but gap down because of lowered forward earnings guidance for 2025. Stock's still holding the 50-day, stock's still holding recent swing lows. Things aren't that bad. I would say Friday things are that bad, right? If we're not able to hold the 50-day, and again, it's not a horrible chart yet, but it's just not a great chart anymore. And so when great charts turn to okay charts, that just means it's not the resilient bull market phase that we experienced for much of 2024. And so I think the story going into next week, and certainly what I'll be thinking about over the weekend for my market misbehavior premium members are, what signs do we look for, and where do we see assets rotating? If they're rotating out of Amazon and out of Alphabet, as we can tell from the fact that the charts are going down, they're rotating out of Tesla, they're rotating out of Apple. Where are they going? Let's find those stocks that are starting to improve, particularly on a relative basis, because those could be the emerging leadership themes. All right, that's it for kind of an initial take on what we saw this week. And again, for my market misbehavior premium members, I take some time when the markets are closed and I've got some time to think over the weekend. And that's when I really focus in on strategy and positioning. So something to consider, hopefully, if that's something you're interested in. All right, let's get to some thoughtful questions from all of you. Again, I appreciate you so much tuning in live, asking questions, watching the replays. Asking questions really makes it interactive and meaningful and helpful. Question 1, just curious, why do you use open, high, low, close bars and not candlesticks? And if you've watched me take questions in any setting, from presentations at a money show to doing a Q&A on YouTube or anywhere in between, being on a podcast, I often get questions about why I don't use candlesticks more. And earlier in the last, about a minute ago, I remember showing this chart where, so I do use them. It's just how much do you need to use them, moment to moment. And I would say, for me, if I'm looking at a 2-year chart of Alphabet, does this chart, the candlestick chart, give you more visual information? Candlestick chart, I think by definition is more visually rich. I think it's more meaningful in terms of visual context. But did you really gain a lot by me changing the 2-year daily chart to candles versus bars? No. And the thing is, there's just not that many pixels to work with when you've got 2 years worth of candle charts on one high definition monitor. So I use bar charts because I'm just looking for daily ranges, really, right? When I'm looking at the overall trend. Now, if I'm zooming in and focusing on the short term, I absolutely look at candle charts. And if I'm looking at an hourly chart, I make that a candle chart usually because I'm trying to think more about short term. So I think for me, every chart you use, there should be an intention, right? There should be a purpose to what you're doing. This comes from time at Fidelity, right? In the Fidelity chart room. When I joined Fidelity in 2008, I was strongly encouraged, if not flat out told, to go to a Edward Tufte class. And everyone on my team had either gone to it or I forced them to do it after I started running the team, because it was a master class, literally a 1 full day master class on data visualization and just thinking about the use of color and shape and lines and annotations and titles and the layout of charts and literally having a purpose to everything that you do. A lot of times charts can be noisy, they can be confusing, and the things I try to show to you are anything but that, because if there's anything on the chart that doesn't really add value, you get it out of the way. And that's something that Tufte, who's a famous author on data visualization, not financial data specifically, but more broad data visualization as an expert. And I think that still inspires to what I do. So, at some point I had a long-term chart. I'm like, candles really aren't adding anything. They're just making it a little more cluttered. And so I got rid of them and it made it cleaner. And so that's why. That's the short answer. So if I am trying to understand short-term price dynamics, I absolutely use candle charts, and I would encourage you to do the same. If you're looking at long-term trends over multiple years, it doesn't really matter. So I like it as clean as possible. I would tell you that on a platform, on a dynamic chart platform like Stock Charts ACP or other platforms kind of have versions of that, I like to get to something like this, where I can look at the candle chart and then other charts all together. So this is one of the views that I like to use that has a focus on relative performance up here in the upper left, a daily chart, which is kind of my key chart, a monthly chart, a weekly chart, the candle chart. And I'm able to sort of, see how the candle patterns look relative to all these other time frames. So I think candle charts are part of the picture for me. And again, if I'm thinking about short-term supply and demand, short-term sentiment, I think candles are far superior. And I would totally agree. Hope that answers your question. Thanks for asking about it. Question 2, Dave, could you talk more about how or when divergences get negated? Yeah, I did mention that sometimes, probably recently on the show. We can look at this chart of Alphabet as an example. So when we talk about bearish divergences, right, just to start us off, we're talking about this, when price goes to new highs and when the momentum is going to lower peaks, right? So higher prices on weaker momentum, a bearish momentum divergence. Now, when does it get negated? Now, the problem is I don't really see a great example of that here. You see other examples of divergences, but ones that we actually did follow through and pull back pretty well. So what would I say? So a divergence, what you have to remember is there are different types of technical approaches, right? Leading indicators and lagging indicators, kind of a general way of bucketing them. And I would say divergences are a leading indicator. You get the initial sign for divergence when a stock is in a clear uptrend, making higher highs and higher lows, right? So that higher high comes on weaker momentum, and that can tell you, all right, this could be a bearish momentum divergence, could be an indicator that new high we're making is maybe the last one. But then you really want to wait for confirmation. And so I would say the confirmation for me comes in the way of the RSI breaks below 40 on a pullback, right? Which tells you the momentum is clearly getting way more negative. We fail to hold swing lows. We fail to hold moving average support. Those would all be ways of validating and I think confirming the bearish momentum divergence. So what would negate it is you never really get that confirmation, right? You pull back maybe a little bit and then we make new highs. And instead of the RSI getting lower, all of a sudden we have a surge higher on stronger momentum. And if you can no longer draw that lower trending line over the RSI because the RSI is actually starting to go up, then it's no longer a divergence, right? So I think for me, it's a divergence is the early warning system. Do we get confirmation based on breakdowns in price and support and moving averages and momentum? If so, that's a valid, topping pattern. If not, if you never get that confirmation, never get that follow through that confirms that the divergence was good, then it's negated, then it's invalidated. And so I think for me, I would rarely sell just purely on a divergence. For me, that usually puts it on a watch list of charts of things that are still doing okay on a price basis, but the momentum tells me we might be at the later stages. And then I set alerts to say, all right, what would I need to see that would tell me to sell out of this particular position? And that's how I would think of it. So great question. And I appreciate it so much. Question 3, what do you make of Fannie Mae FNMA after the end of December breakout? Upside target. Interesting question. I don't get asked about upside targets too often. This is the chart of Fannie Mae. When I started question, I brought it up. So a couple thoughts on this, right? So number one, in your question, you said upside target. And you will note if you watch my content, I rarely identify upside targets. I used to. Back in my Bloomberg days, which was early 2000s, I'm learning technical analysis. All of a sudden, I'm on the road covering, basically eastern half of North America and calling on institutional investors, money managers, traders, brokers, anyone that had a Bloomberg terminal. So some, working for a large financial institution generally, and would talk to them about targets, right? And we would identify, all right, this is, based on the technical analysis toolkit, there are plenty of techniques to help you identify potential targets. There are projection tools like Fibonacci projections or Elliott wave or Gann or all these things that sort of say, all right, if this has happened, then this is where that next peak would probably be in terms of price or time or some combination. And that worked for a while. Then all of a sudden I worked for a growth investing firm, Fidelity, long-term investors. And I remember going into a portfolio manager's office and saying, all right, this stock that you hold just hit its target. We should start lighting up. And he said, he looked at me, he was like, I'm not touching that thing. He's like, that's my best performer. Why would I be selling that? And I learned that from a money management, if you're a long-term money manager, if you're a growth money manager, your best performers, those are what you build your portfolio around. Those are what you don't touch. And if you hit some target, you rarely would lighten up just for that reason. That's when you would almost want to double down and sort of bet on that trend continuing. You would lighten up on the things that aren't working. This is the Peter Lynch methodology, right? Of, if you want to grow a garden, you don't pull your flowers and water your weeds, but that's what you do if you sell your gainers and double down on your losers. You want to flip that. Things are working. You want to rotate out of what's not working and rotate into what is working. You want to pull the weeds and water the flowers. And so price targets sort of drifted away from my approach because wasn't working for people that really were particularly interested in target. They were interested in following trends as long as possible. So what I realize is when stocks are going in an uptrend, you don't, at least for me, I don't think in terms of targets. I don't think, all right, when it hits X, I'm going to sell. I turn into a trend follower, and my goal turns into, let me lock in as much of a gain as I can. So when the stock does turn down, I'm limiting my drawdown at the end, and I'm basically benefiting from the long-term uptrend. So applying that sort of thinking to a Fannie Mae, I won't look at this chart and say the next upside objective is 10. There are techniques and there are people that do that. Elliott wave is a technique that is built around that. Here's the certain structure, which means this is where we could get a next objective. I've not found that a profitable way to approach stocks and ETFs personally. So my toolkit is built around trend following. So I see a stock that is going up. I can say it's going up by the fact that we are making higher highs and higher lows, and the price is above 2 upward sloping moving averages. Given the movement that we've seen here, I mean, this is a stock that's obviously quite small now. I mean, sort of post-financial crisis kind of new world of Fannie Mae. I mean, this is a stock still, this is trading, in a 6 handle. So it's just above $5 a share not too long ago. So immediately when you have a stock that kind of gets above that threshold, that kind of usually becomes my go-to stop. So, thinking this is a good trend and a good chart as long as we hold $5 is kind of how I would approach this. And so for me, my goal is to just lock in and continue to follow that trend as long as possible. And if we would break out and establish a new higher low, I would continue to move a stop up to sort of compensate for that. The problem I have with Fannie Mae as a stock is this is something that is not too far off of being, basically like a pink sheet stock in terms of the structure. You can see that the prices have sort of a weird illiquid vibe to them. And that is the sign of data that's not as meaningful. So I would say for now, it's not, good breakout. And I think that's encouraging. I think the fact that it's gotten up to the price level it has is a good thing because that gives it the opportunity to get much bigger. For me, I would say, looking at this chart and holding $5 would be pretty key. We break below that, all of a sudden, all the opportunity to go higher is probably gone, at least for now, because below $5 is where a lot of institutional investors, certain money managers would not be able to even play in the stock. So that's sort of my answer. And again, I don't really think in terms of upside targets much anymore. There are parts of the technical toolkit that are built to anticipate some of those. But given how much this has moved from very low price levels, I don't know if that's necessarily the way that I would think of this particular chart. I would think more like a trend follower. There we go. I mean, that's those were our first 2 questions. I want to appreciate so much you guys sharing those. Those all came from viewers like you, just sharing questions during our live streams or in the comment section of our YouTube channel. Just want to remind you guys, if this sort of thinking about technical indicators, about entry and exit points, about trend following and how to lock in gains and minimize riding things down and torpedoing your previous returns. If you want to get better at using the technical analysis toolkit, strongly encourage you to think about our Market Misbehavior premium memberships. You can get more information at marketmisbehavior.com/premium. Three things that are really good about this premium membership. Number one, virtual courses. I'll teach you about technical indicators, technical analysis, trend lines, Fibonacci retracements, and everything else in between. Number two would be our members only reports, like our weekly flight plan, which I'll be working on over the weekend, our monthly chart review, where we apply our proprietary market trend model to a series of different ETFs and focus on themes and trend changes. Finally, access to our members only community. It is a growing and supportive group of like-minded investors using charts, asking questions. I'm in there every morning asking questions from our premium members. Some of my other premium members will probably weigh in sometimes and answer and share some perspective as well. But it's a really good group of investors finding success together and growing over time. So I hope you'll consider it. Go to marketmisbehavior.com/premium. If you do check it out, make sure you use the code YouTube when you check out for 20% off your first 12 months on any plan. Great Valentine's Day gift to yourself. Consider it. And I appreciate you taking a look. All right. Excuse me. Let's get to question number 4. I was looking at the composition of DBC. That's a commodity tracking ETF. And notice that 25% of holdings is AGPXX. What does this represent? So it's funny, when you look at the holdings of certain ETFs, you will get into some interesting stuff. And if you try to bring up that particular chart, you're going to get something like this. Is what happens when you bring on stock charts. If you look at it on Yahoo Finance, it's kind of a straight line at 1. That's because this is a money market fund. It's not really a traded security. I mean, the price doesn't really move. It is more of a placeholder for, essentially a cash position. That's a short-term, like government and agency position. The way that things like DBC work is they basically invest in futures, right? So it's commodity futures, wheat and energy and corn and crude oil and gold and whatever else they have as part of the DBC group of commodities. But then they also have a portion, and some, depending on where you look, some websites will list it out as collateral, and it'll be like treasury money market kind of funds. And they use that to get like sort of an income piece that they use to supplement what's happening with the futures from my understanding. So AGPXX is basically like a yielding, like a cash account, basically. So it's probably, it's probably not intended that you would be able to get in your brokerage account. You mentioned in your question, you can't bring it up on your brokerage, and it's not intended for that. But just think of it as sort of a, short-term government agency bond kind of fund that is meant to generate some income to sort of give that complete structure that they're trying to get to with the DBC. With something like DBC, you're basically trying to track commodities, and that is not as easy as you might think because, there's a rollover effect. I mean, you're trying to invest in futures markets or commodities markets and then structure it in an ETF wrapper, which means you've got to do some really interesting things like using these sorts of funds to supplement it. And I would say that the core of DBC, and make sure, like when I'm looking at Koifin, which is the site I usually look at to look at holdings of ETFs, you can see the futures that are in there, and a lot of websites you can see that as well. I'll show you the futures contracts of commodities that they're actually holding, but then there's a separate section called collateral, which is what this and I saw a couple other funds on some of the sites that I looked at that explain what that is. So that's what it is, and it's again just a way to supplement sort of the structure and provide some income to supplement the returns that are coming directly from the commodities that they're investing in. All right. Next question. Do you agree with the notion that IWM will always suffer headwinds to outperform due to the fact that strong stocks will leave IWM, making it skew to underperformers? And I really appreciate your question talking about small caps, which basically saying is if small caps are really good, if a small cap company is really good, doesn't it no longer become a small cap, kind of graduate out of the small cap index? So the Russell 2000 is basically just the things that never made it. That's a fair question. I appreciate the logic that you're using to apply that. And I would say to a degree, excuse me, absolutely, right? There are, I mean, the best small cap names are no longer small caps. Here's the thing though, you know what the number one weight is in the Russell 2000? Now it's 2,000 companies. This is not a huge concentrated portfolio. It's obviously a pretty, diverse portfolio with a lot of different stocks in it. But you know what the number one holding? Sprouts Farmers Market, ticker SFM. And if you'll notice, market cap's almost 17 billion. This is not a small cap company. That is the reality for small cap indexes because they don't roll over, they don't rebalance every day, right? So stocks that are really good in the small cap space will often remain in a small cap index for quite some time before a natural kind of rebalancing process, at which point they may be removed and put from the small cap index into like the mid cap index, or the mid cap index into the large cap index. But between rebalancing periods, there could be big positions where all of a sudden, a Sprouts Farmers Market is nothing. There's no way you can call this a small cap stock anymore based on its market cap, but it started as a small cap, and so it's sort of still in that index. It's up to the Russell people to decide how they want to what stocks they want to pick in their index. Just like it's up to Standard & Poor's or Dow Jones or whoever runs an index, it is totally up to them in terms of what stocks they put in that index. And it's not as scientific, I would say, in a lot of ways as you probably would think it is in terms of index memberships. There's a committee that decides what stocks are going in and also what stocks are going out. And we've seen that in recent years, where companies that had done quite well and all of a sudden start to really underperform, all of a sudden are removed from the S&P or the S&P mid cap and downgraded to a lower index tier. So that's the reality of it. Another interesting observation in my experience of working with money managers that run small cap funds, that one of the secrets of outperforming is you own small caps that are no longer small caps. So if you look at some of the top performing small cap funds, particularly given the dominance of mega cap names, they're holding stocks that are definitely not small caps anymore, but it's within their mandate to hold things that are not technically part of the small cap benchmark anymore. And that is in some ways part of the genius or part of their ability to outperform, is owning things outside of that small cap mandate. So having said that, is that an issue? For sure, right? And I would say that is one potential issue. I would say that issue is exaggerated right now because we're going through a period in particular where mega cap stocks are so dominant. So anything in the small cap space is kind of underwater already, just by the fact that investors are just not generally rotating into small cap companies. They're rotating into larger names. The AI story is not like AI excuse me, dominated by a bunch of small up and coming names. It's Meta and Alphabet and Nvidia, like these big, huge established companies that are, arguably at the forefront of this development because they've got the money to spend and they've got the resources to buy up smaller companies and wrap them into their big kind of conglomerate of technology and AI. So that is just the nature of where we're at in this particular part of the cycle and with this moment in history. Having said that, yeah, I mean, I think that's one of the long-term arguments for going, for looking for stocks that are, sort of getting big enough that they're no longer small caps. Having said that, if we have a scenario where mega cap growth is no longer the place, and if we're in a scenario where value sectors like financials and industrials and materials start to do better than technology and communication services, you will see the small cap index outperform. We've just not seen that in recent years. It's been quite a long time, but there have been times in my career where small over large was one of the obvious plays in a bull market environment. Maybe we get back to that in 2025. So great question. I think the logic is sound with what you're doing. I think just structurally, there's some nuances to that it's probably not as clear and cut and dry as you may think. All right, final question, folks, and then we'll call it a weekend. If you used two simple moving averages, say the 50-day and the 10 or 20-day, wouldn't that be comparable to an exponential moving average, but with more information? This is a really interesting question. This came after I was talking about the difference between simple and exponential moving averages on one of the shows. And this question came in right after, which was, hold on a second. If you're talking about how simple moving average versus exponential moving averages are more reactive, they're more sensitive to changes in trend, which they absolutely are, then why wouldn't you just use instead of using an exponential moving average, why wouldn't you just use a combination of simple moving averages to do the same thing? And the answer is you could, right? The reality is, in the world of moving averages, there are a ton of different options. There are simple, exponential. Those are just two of the weighting style. There's also weighted moving average, where you have more of a linear weighting to more recent data. You have what's called a triangular moving average, where you weight the middle of the series the most and weight the extremes less. There's a centered moving average, where you plot it at the midpoint of the average. I mean, there are a lot of different theories on moving averages. Adaptive moving averages, which is arguably probably the best example. It's like a better version of an exponential average, something that I've seen Professor Andrew Lowe promote quite a bit. But they haven't really become very widespread. I mean, that's another way of weighting the data a little differently. I would say there are innumerable combinations of moving average crossovers of different types of them. And as much as someone would swear this is the only one you need, I always hear that and take that with a great deal of skepticism. I would say there's a lot of different ways to do very similar things in the technical analysis world. It's the same with like RSI. There are other indicators that are very similar to RSI, do things a little differently, could be better or worse in different situations. But in the end, instead of trying to optimize and finding this perfect oscillator that's just going to be the ultimate answer to every question, I think many of them can be very helpful, but they also have their flaws, right? And one thing I've learned is it's less about finding that perfect moving average combination. It's more about finding a pretty good one and then using it consistently. The challenge I found is when you start whipping things around and doing different things and then trying to curve fit to different examples. In my experience, and this is why I use the 50 and the 200 day, and that's pretty much it. And my market trend model is based on a series of exponential averages. If I just kept testing, could I come up with some subtly better combination? Like maybe, but is that really going to move the needle so much that it's so important to me to put a ton of time and effort into trying to optimize it a little bit? Like, I don't think so. One of the things I've learned is, find a combination of techniques and indicators that are good enough and that you can apply consistently. I'm looking more for robust indicators, meaning you can apply them in different situations and they are generally pretty good. I think consistently pretty good is way better than inconsistently awesome, at least with technical indicators. I think there's way too much effort put into trying to optimize and finding some perfect combination. So that is my sort of soapbox high level. So, to your point in particular, yeah, I mean, I would say it's going to depend. And I think to your particular question, could you combine like the 20 and 50 day simple moving averages, compare that to an exponential average? I think there are going to be, depending on the price movements, there are going to be times when that might signal quicker and you would go, okay, that's a much better use of it. But other times that it won't. And it's going to depend on the volatility of the price action itself. And there are probably going to be certain times where one is better versus the other. Generally speaking, though, what you have to remember is with moving averages, you have a couple of variables. You have the period, right? Number of days or a look back period. You have the weighting. All right, if I have this much data, how much do I weight these different data points? And then do I use multiple indicators or do I multiple averages? Do I look at just one? Do I look at the slope? Do I look at two and how they cross over, which is what like MACD does, has a signal line. So basically it just says, I'm going to look at when they cross through one another. Those are all possibilities. In the end, I would find one that resonates with you and helps you identify terms that you're trying to identify and then start using it consistently. That, in my opinion, is the secret sauce. That's what you want to try to get to as much as you can. Folks, that's it. Thanks so much for those thoughtful questions. Thanks for making me think. I really appreciate these episodes and being able to spend some time thinking about some of these topics. I hope you find them helpful as well. As a reminder, we've got some really good podcast episodes. I just sat down with Steve Kress of Seeking Alpha. He runs their quant effort there. We'll be editing that up and hopefully releasing that over the weekend. We did put a video on our YouTube channel announcing our top 10 charts to watch for February 2025. So I hope you will check that out over the weekend as well. And have an enjoyable one. Enjoy the Super Bowl. I won't say who I'm cheering for, but go Eagles. And have a great weekend, everyone. For Dave, for Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.